What I want to do here with my boys, Lumberjack and Dion, is I want to go back to Sunday and really cherry pick a couple of hot topics. If you don't know what Sunday was, we did a 3 hour kind of portfolio review with almost 80 different investors, asking any question they want. No PowerPoint, live questions, get answers. The three of us plus the wonderful millennial Mike was there, and it went for almost 3.5 hours. And what I'm going to do is cherry pick a couple of topics so that we can help everyone who didn't have the luxury of being there. And the first one has to be debt equity, trapped equity. There was probably 40% of the questions that were in and around that, whether it was equity in a home or equity in investment property. What should I be doing? I'm still in growth mode, all of those things. So before we get into debt equity and what people should do and what we talked about, let's welcome the guys to the show. Lumberjack, how are you?
I'm doing super awesome. That event was fantastic. It was a lot of fun. And then I spent 2.5 hours teaching my students.
Yes, you were going hard. 5 hours.
I'm still recovering. that was a lack of wisdom.
Yeah. Well, I appreciate you stepping up.
Of course. Should have pushed my event. Yeah.
That's right. Can I delay this a little bit?
Just like, yeah, at the end, I was just like, can't answer any more questions about real estate. It was a lot of fun.
That was awesome. Yeah, that was good. Thank you for being there. Dion, how are you, man?
Howdy, I'm doing great. I really enjoyed that. Those questions came up so much on the dead or trapped equity that my live stream that comes out on Tuesday at 4 p.m. Pacific, the intro is going to be on the topic of what to do with that equity. And I really enjoyed that. I didn't have the experience with Matt where I then went on to a 2.5 hour, student live. I went out and looked at new neighborhoods.
All right.
Yeah. So we will hit that in episode 2 and 3 because I think that's important. But we're going to stick to trapped equity or debt equity. And again, just one more shout out. Sunday's event doesn't happen without Dion. Dion gave me the idea. I'm looking for topics. Dion sent something out about 8 weeks ago and said, hey, we should do something, the four of us. And I said, you know what? You're right. So Dion gets full credit for Sunday's event. So Dion, thank you for that. And thank you for being there. And Millennial Mike, if you watch this, of course, thank you for you. We will talk about what out-of-state investing in the next couple of episodes. But Dion, you are the teacher amongst us. So why don't you kind of summarize and set up, what you heard, what you saw, and then we'll kind of get into that.
So, I mean, you've been putting out content for 5 years, I think, 2018-ish. And we work with people, and it always shocks me that, about 60% of the people who view at least my channel don't have a rental yet, and they're looking to get started, which means 40% do. And some of them have had them for a while. So either people purchased properties before 2020 or refinanced in 2020 in most cases. Mm-hmm. Since 2020, properties, and I've got proof on a couple of property, what do they call them, valuations. We've had an 80% increase since 2020 in my market. So it's like 81 to 83%. And
so just to put some numbers to that. So you buy something for 200, you see an 80% increase, that goes to 360.
Yeah. So exact numbers, I bought 298. Now it's like 480 something or 580 something. So it's not quite doubled, but it's really close. And that's kind of consistent in a lot of markets. Mm-hmm. And then you add the low interest rate. And so people are sitting there with hundreds of thousands of dollars in unplanned for equity. If they're doing it right, they purchase saying this will cash flow. I purchase those properties. They will make money every month. And then, wow, there's several $1 million sitting in equity in my properties. And so I understand why those questions came up. It was really great. I love the format of the Zoom with that many people because you could tell that there were some people that never turned their camera on. There were people who wanted to have their camera on, watch the facial expressions of the people asking questions. When you do the raise your hand thing, you could see the line of people asking questions. And sometimes a question would get asked and they would drop off because that was literally the same question that they were working, they wanted answered. And then to get, usually 2 or 3 answers from the 4 of us, if it related more specifically to what we did. And I think it was a great format.
Yeah. So let's talk about this because again, and I think one of the important things that we hit on right away is where are you in your investing cycle? Because there were different answers, right? If you're still in highly growth mode, there was kind of one set of examples. And then it's like, hey, if you're in the enjoy your life stage, maybe there's another consideration. And again, I go back to my story. If you read my book, One Rental at a Time, My $40,000 that I had for my stack was gone after my third house. So I go house 4, 5, 6, 7, 8, all with AKA trapped or dead equity, right? These were all cash out refis that led to the next 5 purchases. So I get it. And like the folks on the call, my market, Fresno, California was the #1 market 2 years in a row. I think 04, 03 and 04, or 04 and 05. Total shock, total surprise. Didn't know it was going to happen. I knew they cash flowed, but I was in high growth mode. And at the time, I was like, ladder them up, right? Don't go negative. I made that mistake on my first one. I took out too much. So that lesson learned. Didn't do that again. But so I know what people were doing. The only difference is my interest rates actually went down when I refied, right? I took out cash, and a couple of examples, my payments went down. And that's a no-brainer to me. Oh, I'll give you $20,000 and a smaller mortgage payment? Yes, please. I think it would be a lot harder today for me to do a cash out refi because I think they all go negative. They all become alligators, right? I go from a 3.1 to a 7.7.
Right.
I get 20 grand, but now I'm negative. No, thanks. I'm not doing that. So Matt, what did you see with all the interactions? Because again, 30 to 40% of the questions were one version or another of debt equity.
Told you so. Like, you're going to get a bunch of equity that you can't get access to. Like, and this is what all the crash bros just don't understand. They don't get it. There's so much equity there, but it doesn't cost you anything, right? It's paper millionaires. How many people are paper millionaires? Well, I've got $1 million or $2 million or $5 million of equity in my properties. It's not real money unless you can get it. And so I thought the event was awesome because we were obviously answering questions that were important to people. I think consistently, and it's not to pick on any one individual, but I think what's interesting is the amount of time that people will spend consuming free content, and they won't spend a couple $1,000 on all 3 of our courses to get elite at something. Like elite. Like, we've got almost 55 years experience doing this thing in multiple markets in over multiple decades.
Yeah.
And so that was the thing that shocked me the most. But when it came to the trapped equity, you can get access to that equity. But like you said, you're not going to give up a 2.5 or 3% mortgage. But now you're going to go out and you're going to get a HELOC.
Yeah.
At 9%. You just better have a plan of what that was going to look like. And quite frankly, all due respect, if you were watching us for the last 1.5 or 2 years, you're in a really good position if you listen to any of the advice that we had. Even if you did what Dion did, which was nothing.
Yeah. But at least he knew it. At least he knew it.
Right. And but hey, here's the thing. We don't agree on a lot of stuff, but it worked for him. And that's what's important. That's what that perspective gives you. He did nothing and he's still in a great position. So he has equity that may or may not go up or down. It doesn't matter. He has more than enough financial money on the monthly to do whatever he wants. And so I think that guys that got more aggressive, like you and me, I'm sitting on more cash than I ever sat on in my entire life.
Yeah. I mean, I'll go one step further, right? Not only more cash, but more equity than I've ever had.
Sure. But let's go another step further. My revenues are higher than they've ever been.
Yeah.
My
revenue margin. Yeah.
Literally everything is higher and better.
And I want to be very clear on that. We called this out 18 months ago, what we were doing on purpose. It wasn't fun. Refining a portfolio of our size is not fun. But now it's like, okay, where you whack, I don't know, make shit up, 20% of the cost because you got your rates right. And oh, by the way, inflation is real. So, that's why I love our channels. I always say we have receipts, right?
Yeah.
Just go back and watch it. So, when we talk about debt equity, again, let's set this up. Because again, if I go back and I kind of paint the picture of the average, which is always hard to do. Let's say the average person asking us had 1 or 2 properties. They bought as early as 18. So again, they're sitting on equity. Let's assume they refied. So their mortgage rate is 3.5%. So that's who they are today. I think going out and doing a cash out refi today for most of those folks is frankly idiotic.
Agreed.
Right. You're going to get a 7.5 or an 8 for a cash out refi today. Even if it still cash flows, the cash flow would be it's not worth it in my opinion. Would you guys agree with that? A cash out refi for most folks is silly.
One of the things that I don't think people consider often enough is how many years in the term they've paid down as well.
Yeah, true. Yeah.
Right? Like I've got some 20-year mortgages. I think I have like 4 years or 5 years left on them. There were a couple of things and now it's almost all principal pay down.
Right.
So I have one asset that I paid 115 grand for. I think I owe, now it's worth 3.25, 350.
Mm-hmm.
And I think I owe 22 grand on it.
Right. So
I can re-lever it with debt, which is probably not going to be my choice in all honesty on that asset. I'm probably going to sell that asset. Right. And then I have $300,000 to go buy myself another $1.3 million worth of property.
Right. So let's talk about that. I wasn't going to go there first, but there is an opportunity to 1031, right? We had one gentleman talk about he was on the West Coast and he wants to go somewhere else. He was Harry was later in life. And my answer, and I basically told Harry he needs to stop looking at numbers. I don't actually know that I've ever said that before to any investor.
Your answer was brilliant. I thought it was brilliant.
Go figure out where you want to be. You've got 20, 30 years left. You've got your chips. Go enjoy life. Stop chasing that extra 2 or 3%. Right? Don't do bad deals, but go.
Yeah, you were not taught. You literally, the two of you on that. I was wondering who I was doing a live stream with. Dion's talking about levering up assets.
Exactly.
And you're talking about yield doesn't matter. I'm like, what show am I on? What freaking show am I on? Dion's like, yeah, we could lever them up, two of them 50%. And I was like,
who's this? Who's this guy?
What the hell? What happened? It's a chip they implanted him in Portugal and it came back. And now he's like, lever shit up.
He's got a parasite somewhere. It's just, yeah. Oh my goodness. Yeah, I think that was the same topic. I think Harry had 4 free and clear. If it wasn't Harry, I apologize. It was somebody else. And you were like, hey, if you're in growth mode, go 50% LTV. What happened, Dion? Is it good for someone else, not good for you?
Well, it's a numbers thing. You have 4 free and clear, lever 2. I have 7 with 1 free and clear. That means I'm not levering that 1 free and clear. And to reward anybody who's made it this far into the video, I was looking around. I don't have it in the room. I was going to put my teaching hat on and actually say, this is what you do with equity. There's 3 questions you can ask to tell you exactly what to do with your equity. 2 that I've been using for a long time, and 1 that came up during this Zoom call. And this is going to be my question going forward. So people get those first 2 questions in the wrong order. The first thing people ask is, I have all this equity. How can I tap it? So they say, how do I get the equity out? And you have several options. 1, a HELOC, right? And most people that have purchased or refinanced in 2020 have such a low interest rate that a cash out refinance is unattractive because it changes the interest rate on the existing debt. So either a HELOC, which doesn't do that, or a second mortgage, which also doesn't touch that existing debt. And the choice between those is, can you pay it off before the rate adjusts? And would you like long-term fixed rate debt? So to help you pick, or would you like to only pay interest on what you're going to use? Like you can make that logical free of decisions. The third option that Matt mentioned is you have an asset that you can sell. You take the debt equity and you have more to redeploy. And so that's the question almost everybody starts with. How do I tap my equity? Use a 1031 exchange, or I live in it for 2 out of 5 years. I benefit from the IRS 121 rule. Don't pay capital gains tax on up to $250,000 in taxes unless I'm married. Then it's $500,000. Not worth getting married. The other option is the HELOC or the second mortgage. But that's the wrong question to start with. The first question that should happen before that, and this is actually in the wrong order because of the third question. The third question I came up with that dawned on me during that Zoom call comes out before anything. So the first question is, do you have a deal or reasonable expectation to put that money to work to justify the added debt to the existing asset or the sale and loss of the existing asset? And that's not, I think I can probably get no, I mean, that there's deals in your market, in the asset class that you invest in, where you will get the return that justifies both the purchase of that asset and the debt on your existing asset. So that was what I would normally teach. Those are the 2 questions, and people get the order wrong. Here's the third question that came up during this Zoom, and this is the determiner for me as to why I've never actually sold something. I have a paid off house that I paid $100,000 for. It's now worth over $400,000. It's paid off. There's over $400,000 in dead equity sitting in that house. And here's why I don't sell it and deploy the $400,000. If somebody purchased a house in 2018 for $200,000 and now it's worth $400,000, you purchased it and you refinanced in 2020 to a 3% interest rate. So you have a $200,000 house at 3% interest in a market where it's worth $400,000 and interest rates are 7%. If you looked at your market today, in that situation today, and you saw a house that no one else was bidding on for $200,000, and you can get a 3% interest rate loan, would you buy it? In a market where they cost $400,000 and interest rates are 7s, everybody would pounce on it. Well, you own that asset.
No, you already do.
Asset that you would go and pounce on to buy. Why would you sell it to redeploy equity? Unless you have the deal that justifies the sale or loss of the asset.
Right.
You are confident in your ability to do it, and the sale makes more sense than the HELOC or the cash out refinance and the second mortgage. But that's the thing for me. That's why I don't ever plan. I don't care if the house became worth $10 million. If I could buy a house, I originally bought it for $100,000, refinanced for $150,000, but it's now worth over $400,000. And it's paid off. So I have a 0% mortgage at zero owed. Would I buy a house for $0 that's worth $400,000? Yes. Why sell it to go through all the work, energy, and effort to find something that hopefully justifies the loss of that asset and the new debt on the new purchase?
Yeah, there's just so much to think about. I think a lot of people look at debt equity because they look at it as their only stack of investable capital. And they know they need to grow. It makes logical sense. But I do think a lot of people get the order wrong, to your point. I think a lot of people rush to get the cash when the deals aren't there, right? That's why a lot of them, I was like, just get an equity line. If you want to feel like you have dry powder, but not have the cost, go spend a couple $100 and get an equity line. But also we must realize that some of the folks are on that show, like myself, we're near the end. So we're actually making different choices with trapped equity. One of the things I think I talked about there, if not, I've talked about subsequently, is one of the things that I will likely be doing is selling some of my older homes, 1031ing into new construction. That deal will make less financial sense, but when I die, my daughter will get a relatively young home, right? So one of the things I'm doing at the end of this, because I'm closer to the end than the beginning, is I will be taking some assets that are not necessarily, they're ugly ducklings or whatever they are. They're just old. I will sell them, 1031 in the new construction, which will undoubtedly be a lower yield because my plan for that house is to give it to Teresa and it'll be, a 30-year-old home or whatever it'll be versus a 100-year-old home the other way. So again, there's different things. Everybody's not in growth mode. Sometimes you make lifestyle decisions. What do you think of that, Matt?
Someday I'll make some lifestyle decisions.
Not
Yeah,
today.
I mean, it's and that's the thing is, I look at it and it's, I was arguing on one of the car message boards because obviously now's the time to be shopping for these exotics.
Yep.
Guys are getting ready to sell and they've taken a nice hit in the market, but there's still more to go. Okay. And people say to me, they're like, well, why would you buy a car like that with 9% debt? And I said, because I make 22% on my money.
Yeah.
How would I not?
Yeah.
13 points. And so I think that, Dion's exactly right, where you always have to see what are your returns going to be on the other thing that you're going to do, and it's like, I'm even considering in some cases where it's like, you know what, I'm not going to do anything with this money. I know I have no purchase coming where I have to touch this $500,000, let's say, or $250,000. Might make sense to throw that in a 5.5% yield, treasury, because I can renew it every month. And at the end of the year that, it's going to pay me 12.5 on that money. Right. But that's where I think people can consider those things. I didn't consider those things only because I'm still in growth mode. Right. We're still doing a significant amount of transactions and quite frankly, the best return on my capital right now is rehabbing units that I inherited tenants on. I'm putting 15, 20,000 bucks in there and I'm seeing 30, 40, 50% returns on my capital. And then my rent rate is raised forever. So I think that people need to understand their money. They need to understand return on capital, the rock. They need to understand yield. They need to understand these concepts, because that's going to help give you an idea of what your process is, because most people watching our channels are growth mode. Most.
Yeah, for sure. No question. Yeah. Again, what I would tell people under this kind of debt equity is first, congratulations. You took action. If you were one of the crash bros and were sitting on the couch waiting for a crash, that you wouldn't have that. So congratulations. I would tell most people, it felt to me that most people were like in a rush. I don't think you make wise financial decisions when you're in a rush.
Right.
Hence, I thought equity line was the right answer for most of the conversations. But let's wrap this up. We've got a couple other hot topics. Dion, any closing thoughts, and where can people find you?
You can find me right here on YouTube, Dion Talk Financial Freedom, and at diontalk.com. And the closing thoughts is, you nail it, Mike, with people are in a rush. And this is actually the unpopular opinion, especially in this group. It was 2 years of saving to buy my first house hack, and then 2 years of saving to buy my first investment rental purchase. That's 4 years to do two things. Yeah. And a lot of people are thinking, I have this trapped equity. I hear you can buy zero down seller financing. I need to rack up as much debt as possible. There's another option. Slow and steady wins the race. It takes 10 years. It's not fast. It's not sexy. It's, you say it perfectly, Zuber, with, it's not get rich quick, it's get wealthy for sure.
Exactly. Yeah, exactly right. Lumberjack, closing thoughts, and where can people find you?
Slow is smooth and smooth is fast. And speed kills.
Yeah.
That's the way it goes. I see a lot of guys that are really levered right now. A lot. And I'm not wishing them any harm whatsoever. I just know what a day looks like when you're that levered. When you're that levered, it's really stressful, because something goes sideways and it starts to domino. That's what happened to me in 06, 07, 08. That's what happened to me. And I was able to stop the dominoes, but that's what people need to really understand, is that's what, sadly, the crash bros are talking to such a small segment of investors that they just don't understand that most aren't over levered. Most investors do have healthy margins. Most investors do have emergency funds that they can pull from. So I think that people, slow and steady wins the race. Slow is smooth, smooth is fast. And if you're not in a hurry to get successful, you'll be just fine. Yeah. It's that I always talk about that constant consistency, but it just carries with it consistently doing the same things, constantly doing and consistently doing those same things, but recognizing that, a 3-year-old can't act like an 18-year-old. And that's when it comes to looking at your portfolio and how you're managing. Recognize that those formative steps when they're babies are really, really important.
Yeah. And where can they find you?
Lumberjack Landlord on YouTube and Instagram.
Thank you, buddy.
Sure.